we logged out. It was because of some network issues and something that we needed to take care of. You're welcome to Odisal Associates, Accounting and Finance Tutors. Today, like I said before, my crew decided to take me on our words and said I should present something, though we only came to do some editing, but they insisted I should do something. So I said, okay, there's no problem. And that it should not be just for my class alone, but for everybody that is interested in accounting or in finance. So something quickly came into my mind, and I said I was going to look at accounting equation, the accounting equation. Of course, it's a very fundamental concept in accounting. I can say it's the bedrock of accounting, because when we say that we have to have a double entry in accounting, it is expressed in the accounting equation. If you look at the statement of financial position, we have the asset side and the equity and liability sides. And we say that the two of them will be equal in order to make the accounting balance. We talk about trial balance, balancing, and all those things. At the end of the day, everything that is done in accounting is finally brought into the statement of financial position, which is stated at a particular date. So that's why I said this accounting equation is a fundamental concept. The accounting equation expresses the relationship between assets, liability, and equity or capital, as the case may be. Now, when we look at this expression, we'll find out that sometimes, maybe at the beginning of the business, you find out that asset is equal to equity or capital when the owner of the business have not borrowed money or has not bought something on credit. But as the business goes on, the business is financed either by borrowing of money or by buying things on credit, not paying for what you have bought. So in such a situation, we have what is called liability. So I will state the accounting equation. Accounting equation states that assets, or we can just say asset is equal to liability plus equity. Assets is equal to liabilities plus equity. So it is defining the relationship between assets, liability, and equity. As we can see, asset is on one side, while liabilities and equity are on the other side. Like I was saying before, when a business starts, we have assets. At that point, there might not be liability. The owner of the business uses money to start the business. So we have asset is equal to equity. I would like to put capital in bracket. This is to say that all the assets of the business were bought using the owner's equity or owner's money. That's what they use to acquire these assets. That's why in the statement of financial position, you can see financed by. When asset has been stated, you see financed by, which means this is what is used to finance the assets that you see. Again, when the business grows, of course, you know that it will be very difficult to run a business without credit on cash basis. Of course, there are things that will be bought on credit. There are things that will be used and have not been paid for. As such, when we have such situation, we will see that not the business is financed not only by equity. The asset of the business is not financed only by equity, but by those people who gave us something on credit, by those people that we borrowed money from. They are also part of the people financing the business. So in such a situation, the formula or the equation is expanded to say asset is equal to liability and equity, because we now have other people that have contributed money to finance the business that are not part of the owners of the business and not equity. So we have liabilities, which is money or financing that came from outside the business, the owners of the business. So we want to see how this is, how it affects our accounting. Well, first and foremost, we'll look at all this one by one. This concept, this, and this. Of course, I'm going to define asset using the conceptual framework for financial reporting, which say that asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits, has a potential to produce economic benefits. So we have seen the things that are in the definition. One is that asset is a present economic resource. Present economic resource. Present economic resource. Present economic resource. Okay. Now, it says that it flows from, as a result of past event. Past event. And that economic resource must be capable of producing future benefits. Potential benefit. This is actually how asset is defined in conceptual framework for financial reporting. This is a present economic resource that flows from past events. And okay, that's another one. Controlled by the organization. It is controlled by the organization and it flows from past events and should have what is called potential benefits. Now, what it means is that what can stand as an asset for an organization is economic resource that is owned by that organization. That either is bought to them or is gifted to them or is a grant from the government, however it comes to them. But this belongs to the organization, and they also control that economic resource, and that it must have been generated from the business. Remember that I said when the business starts, it starts with equity, and then the equity buys the asset. So it's the business that bought that economic resource. And then it should be able to yield future benefits. Now, I want you to know that when an asset fails to meet any of these conditions, it's no longer regarded as an asset. If it's not controlled by the organization, that means it does not belong to the organization, controlled by the organization, and it does not have potential benefits. It cannot bring potential benefits. It cannot bring future benefits. Then it cannot be said to be an asset. So long as it meets this definition, whatever it is. In a layman term, we can say that it is the property of the business that is used to conduct the business in order to raise uh, income or revenue for the business. So we can look at it as a property that belongs to the business. And that property can be used to make revenue for the business. So that is what it is. Now, I would love to actually break it down a little. So we want to look at what assets are. So in asset, we have what is called non-current assets and current assets. Non-current assets and current assets. Before now, we call this non-current asset fixed asset. Fixed assets. That's what we call it. Now, we look at non-current assets as assets that is used in the organization. The benefit that it brings to the organization is beyond one accounting period. It lasts beyond one accounting period. That is non-current assets. It is not current because it's going to serve the organization beyond one accounting period. We don't want to go into the classification of medium term, short term, and long term. We are just going to look at non-current and current. So every property of the organization, or what we call asset of the organization, that will last beyond one accounting year is known to be non-current assets. So in non-current assets, we have tangible and intangible assets. The tangible assets are the assets that you can touch, feel. They are tangible because you can see them, you can touch them, you can feel them. It's like a practical thing that you can see. So that is a tangible non-current asset. And then we have intangible. These ones are the ones that you cannot see, you cannot touch, but they exist in theory and in concept. Maybe represented by a paper or by agreement. So when we talk about intangible assets, we look at things like goodwill, we look at things like patent, we look at things like copyright, brand, and all those. Anyway, we are not actually dealing with assets and non-current assets and current assets. We're dealing with accounting equation. I only want to throw light into what an asset is. Maybe when we want to talk about elements of accounting or financial statement, that's when we're going to treat asset as the case may be. Then the tangible assets are things like building, land, uh, leasehold property, furniture and fitting, office equipment, there are many. So we can also call them PPE, property, plant, and equipment. It can summarize the tangible assets, plant, property, plant, and equipment. So this is what is known as non-current assets. Then we have current assets, that assets whose benefits are expected to materialize in one given accounting period. It will not extend to another accounting period. However, we know that most of these current assets also last beyond one accounting period. But however, it was not intended to last beyond an accounting period. In fact, any asset whose duration or expected duration or expected benefit goes beyond one accounting period is not a current asset. All the current assets that we're going to look at, they are expected to expire within one accounting period. So in current assets, we have things like bank and cash. Bank and cash. Of course, you know very well that the bank and cash we have in our business are like our operating capital that we use every day. In fact, the money you see today is different from the money you see tomorrow. Even if you have like 1 million naira in the account, you go and collect that 1 million and pay in another money. The 1 million can continue to be there in the account, but however, it is not that 1 million that was from the beginning that you are seeing in your account. Yes, we also know that there are some cash that can now be classified as a non-current asset. If this cash is kept there for a particular purpose that will materialize in more than one accounting period, in such a situation, even though it is cash, it's not going to be a current asset, or even though it's a bank. When I say cash, it's interchangeable, bank and cash. So it will not be called current asset. So now we also have inventory or stock. Inventory or stock. Inventory are things that we buy to resell. Things that we buy to resell. This is known as inventory, or we call it stock. Nobody buys goods and expect that goods to last for more than 1 year in your hand. Everybody who buys goods for sale will want the goods to be bought immediately. In fact, they want to place order so that the goods, you just go and carry it from where you are buying it and hand it over to the people who wants to buy it from you. So it's not expected to last beyond one accounting period. But however, if it lasts beyond one accounting period, it is because it has not been bought also. Then we have debtor or receivables. Receivables, and we call debtor. When you do business with somebody also and they bought your inventory for you without paying, they become debtors to you, or what we currently call receivables. And there is nobody who expects his debtor to owe him for 1 year or so. We say, okay, we'll give you 90 days to pay. If you are giving someone 180 days, it's quite long. 90 days, 30 days, 60 days. So this is what we call debtor. It is also part of current assets. It's part of current assets. And then there is another current asset I will talk about, which is prepayment. Prepayment. That is when you make a payment for something beyond the accounting period, but that is supposed to be something that will just be within an accounting period, but you paid beyond the accounting period. In that case, the balance that is with the person you paid the money will be termed as prepayment. Let's assume you have you rented a shop that you're operating from, and that shop uh, is the shop owner takes 1 year rent from you, 1 year rent. That's all you pay. But however, you made that payment in June or in 30th of June, you made the payment 30th of June, and you paid for 1 year. That payment has exceeded the, the period of 1 year when your account will be prepared. Because let's assume you prepare your account at 31st of December. 31st of December. What it means that the 1 year amount you paid, by 31st of December, you will still have 6 month rent that you have not used. That you have not used. So this is that amount will be regarded as prepayment. Or when you have when you pay for 2 years, you are only going to look at the current year due. The subsequent year will be regarded as prepayment. Now, this is because of the matching concept that requires you to match your expenditure to the revenue or the income that it was used to generate. Now, if you had paid the rent for 2 years, but however, you are only accounting for the first year, the rent for the next year will not be available to use this year. And it was not used to generate the income of this current accounting year. So such a situation, we have prepayment. Topic is not on assets, liabilities, and equity as the case may be. It is on accounting equation. When we are treating, when we want to talk about the uh, conceptual framework of financial reporting, we're talking about the elements of financial statement. That's when we actually go in detail of how this is treated. Okay, now the next one is liability. Liabilities. This one is talking about obligation of the business. I'm going to give you the conceptual framework for financial reporting's definition. It's a present obligation of the entity to transfer an economic resource as a result of past events. Okay, we talk about present obligation, yeah, of an entity, and then we talk about transferring of resource. And coming from past events. Now, we say that liabilities are obligation of the entity, and there must be obligation that is existing now, even though it came from the past events of the organization, from past transaction of the obligation of the organization. It's said to be a present obligation. Now, that obligation is for the entity to transfer resource. Resource here can be money, can be service, can be anything. as we have talked about assets, we said asset is economic resource. So the company is liable to transfer economic resource to another person. That means an agreement has been reached between that person and the company or the entity, as the case may be, that I'm going to do this for you. If you don't have money now, you can pay me later. I'm going to give you money now. Later, you will refund that money. You will repay that money. So all these things are called liabilities. So in liabilities, we also have non-current and current liabilities. Non-current, current liability. So the non-current liabilities are obligations that are settled beyond one accounting period. That the obligation that will last beyond one accounting period. Let's assume I borrowed money from the bank or from the stock market. I raised money. I'm not expected to pay it in the current accounting period, but to last for 3, 4, 5 years before I pay. So in that case, it is known as non-current uh, liability, which means the benefit that will accrue from this liability that I took will go beyond one accounting period. And I am going to make the payment after the current accounting period. So it's known as non-current liability. We have things like loan note, we have bonds, we have bank loan, some bank loans actually that will last for a very long time. You can take loan from bank and you pay them in the next 3 years or 4 years. That is known as bank loan. Then the loan notes are equity that is raised from the capital markets and bonds too. So these are non-current liability. Before, we used to call it long-term liabilities, but now we call them non-current liabilities. While the current liabilities are obligations that will be settled within one accounting period. Obligation that will be settled within the current accounting period or one accounting period. That is current liabilities. In current liabilities, we have accounts payable, we have accrued expenses, or what we call accrual. And then we have bank overdraft. Bank overdraft. All these are expected to be settled within one accounting period. Accounts payable are the people you bought goods for on credit that you need to pay. Just like our receivables, we don't expect it to be settled uh, in more than 1 year. That's how we don't expect to settle the payables in more than 1 year. So within the accounting period, we are supposed to settle the accounts payable. The same goes to accrual. Is the reverse of the prepayment that we talked about. Uh, that's how when you expense, when you incur an expense and you have not paid for it, but you have used it. So that's an accrual. Then the bank overdraft is when you go to bank and take short-term loan from the bank. An overdraft, the bank normally allows you to draw above the amount you have in the bank. So that's an overdraft and is a short-term or a current liability. as the case may be. So we are going to look at equity now, or capital. Equity or capital as the case may be. Equity. The conceptual framework of financial reporting also defines equity as a residual interest in the assets of the entity after deducting all its liabilities. Of course, what it means is just assets, equity is equal to assets minus liabilities. So this is the way the conceptual framework for financial reporting defines equity. Assets minus liabilities, residual of the excess of assets over liabilities. So that is equity. Now, in equity, we can have ordinary shares, we can have preference shares, we can have share premium, we can have retained earnings, we can have reserves. So when you put all this together, that is your equity. So these are the components of the accounting equation. The components of the accounting equation. We can say accounting equation is equal to assets. Is asset equal to equity? Okay, I can say liability plus equity. Okay, you can see this equation. Most of the times we say asset is equal to equity plus liabilities. The reason why we bring equity first is because equity is the first thing that the owner of the business bring into the business and then use it to procure the assets of the business. However, quoting Professor Cabell, he said because liability is something that will be settled first before equity, if in terms of liquidation also. So he says he's bringing liability first before equity. But that does not change the accounting equation, whether it is equity first or liability first. I have given you the reasons why why some choose to bring equity first and some choose to bring liabilities first. I've quoted an authority for bringing liabilities first, and that is why I'm also bringing liabilities first. So we have seen that this is the accounting equation, and as it is, you can make any one of them the subject of the formula. We have made equity the subject of the formula by saying equity is equal to assets minus liability. We can also say liability is equal to assets minus equity. So this is how we can make any of them the subject of the formula. Either we use assets and we have this. We use equity, we have this. And we use liability, we have this. Any of them is going to give us the same answer. So what it means is that if you have assets and equity and liabilities, you can determine your equity. If you have liability and equity, you can determine your assets. If you have asset and liability, you can determine your equity. So any one of them that is missing, because of this relationship, you can always make that missing one the subject of the formula. And then you will have the other one that was missing. So if you are given an incomplete record, with this formula, you can also derive the, the one that is missing. Let's assume you went into, you want to prepare account for somebody, for a company, an organization, and the person told you that he did not know how much he invested in this business. Maybe even though he might have the name out where the number of shares that he floated is written, the amount he paid for the share, the value of the share is there. But however, you know that the owner of the business will spend even beyond what uh, the capital structure, I'm sorry, will even spend beyond what the share, the nominal share or the authorized share or the issue share in the MEMAT is. So in such a situation, you can get all the assets and then all the liabilities. And then whatever that is here becomes the equity. In such a situation, you can look at the amount of shares in the company's MEMAT, and then the rest you can assign it to either retained earnings or share premium, as the case may be. Now we want to look at, we have seen this. The next thing is for us to look at how transactions will affect this. How transactions will affect this, the the accounting equation. I also want to tell you that this can also be called the balance sheet equation, because in the balance sheet, like I told you, or what we call statement of financial position now, we have the equity and liability side. If we have a T account like this, then we have the assets. So that's why it is also called the balance sheet equation. Now we have changed the name from balance sheet to statement of financial position. But however, the IS1 says that you can call it any name you want to call it. It doesn't change what it is. So right now we are calling it statement of financial position. But however, the equation still remains the balance sheet equation or the accounting equation. Now we look at how transaction affects uh, affect this equation, because one of them, if there is any change in one of them, it will affect the whole equation. So if we look at transaction is an economic event that affects the assets and the equity of the business. Any economic event or financial event that affects the assets and the equity or the liabilities of the business is known as transaction. So whatever you have done that has impact on the assets or has impact on the equity is known as transaction. Whether it goes up or it comes down, it is transaction. Transaction does not mean that it will bring profit or it will bring loss. It can bring any of them. The transaction can either lead to profit or can lead to loss, but it's an economic event, it's an activity, an economic event, an activity that is undertaken by the entity that will change the assets, liabilities, or the equity of the business. So every transaction will always lead to a change in this accounting equation. That is why when we prepare the statement of financial position, we say assets, assets, assets. It's important for us to note this, that our statement of financial position is always prepared asset. Because any moment from that time when any transaction occurs, the statement of financial position will change. Immediately any transaction occurs, it will affect the statement of financial position. So that's why we're saying if we are preparing it now, we say as at now, because tomorrow, subsequent dealings or transactions will bring about a change in that statement of financial position. So we want to see how transactions will affect this equation. So the transaction can be in assets, in liability, or in equity. Let's take, for instance, we bought a motor vehicle. A motor vehicle, like I said before, is a non-current asset. I hope I listed the non-current asset. The motor vehicle is a non-current asset. Furniture and fitting is a non-current asset. Okay, we bought a motor vehicle. So in that case, it will be, let's assume we bought and paid cash. We bought and paid cash. In such a situation, you will see that this equation will remain what it is. It will not change. The value, the total value of assets will be the same. The total value of liability will be the same. The total value of equity will be the same. Why? Because our transaction affects only one aspect of the equation, one side of the equation. One aspect is increasing while the one side is decreasing. So they compensate for each other. Let's look at it. Bought a motor vehicle for 50,000 naira. Sorry, let me get a better marker. Bought a motor vehicle for 50,000 naira. Now, let's say cash. Cash. Okay, this one is right. We have two accounts that are involved, motor vehicle and cash. All of them are assets. Both motor vehicle and cash belong to the same group of account assets. So what it means that motor vehicle has increased and cash has reduced. Let's take typical balance sheet equation. Assets 1 million is equal to, this is assets, liability 300,000. Liability 300,000 plus 700,000 equity. Okay, we have assets equal to liabilities plus equity. And it's represented by asset 1 million, liability 300,000, and equity 700,000. Okay, if we bought this vehicle for 50,000 naira, what it means is that assets, the vehicle will increase. Let's assume that inside these assets, we have motor vehicle worth 200,000 naira. 200,000 naira. And then we have cash, motor vehicle, and then cash. 100,000 naira. That's what we have. Now, when we bought this motor vehicle, what it means is that we have added to the motor vehicle 50,000 naira. And then we have removed from the cash 50,000 naira because it's from the cash that we paid the motor vehicle. So motor vehicle will become 250,000, while cash will become 50,000. So if you add this, you have 300,000. If you also add this, you have 300,000. So nothing has changed in the assets side of the equation. So the total asset will remain the same, even though the individual items that are in the total asset will change. Like motor vehicle will increase to 250,000, while cash will reduce to 50,000. But the total value of the two of them put together is still 300,000, 300,000. So in such a situation, you see that it will not affect the balance sheet equation. The values will still be the same. Now, let's assume that this asset was bought on credit. So we'll say 1 million equal to 300,000 plus 700,000. So let's assume that this asset was bought on credit. The 50,000 naira worth of the asset has not been paid. It will change the equation. It will affect the equation. Because what it means is that asset is going to increase by that 50,000 naira. And liability also will increase by 50,000 naira. This one remains the same. This one becomes 0. So if you add it, you have 1,050,000 naira. That equal to 350,000 naira plus 700,000 naira. So you can see that because it affects two accounts that are not in the same group, what I call in the last video I made, debit and credit. I said they do not have the same balance. They don't have the same normal balance. That's what I said. The two elements that are not in the same group, that do not have the same normal balance, all of them will increase in order to balance the account. So you see that asset has increased from 1 million to 1,050,000 naira. Liability has increased from 300,000 to 350,000 naira. That is the effect of the change or the transaction that has been made because it was made on credit. So you now see that the total asset value of the company has increased, but the equity still remains the same. Even though the asset value has increased, the equity remains the same. It will not change. Now, let's look at another situation where the owner of the business brought in more money, either by issuing of cash, of shares or so. And then we said there was an issue of share of 1 million naira. Share was issued for 1 million naira. This point again, the statement of financial position will change. Let's assume that this is cash, right? This should be cash or bank. I said cash here is both cash and bank. So they issued 1 million naira worth of share, cash. Let's disregard cost of issue and look at the loan naira. I think we are saying that is what they brought into the business. Two accounts has been affected. The share account and cash account, the share account and cash account. Let's look at this as ordinary shares. Ordinary share. Ordinary shares. Now, ordinary share here is equity, while cash is assets. Ordinary share is equity, while cash is asset. So in this case, what it means is that the equity has increased by 1 million naira. Equity has increased by 1 million naira. I'm just going down. 1 million naira equity. And then cash, 1 million naira. While liability remains the same. So at a given time, the equation must balance. That's why it is called an equation. So you now see that our asset base has increased to 2,050,000 naira. Liability is still 350,000, and then the equity has increased to 1,700,000 naira. So this is how we have seen there is increase there, increase there, increase there, and it has changed the accounting equation. When assets increase and decrease, it did not affect the equation. It's only when it is on the other side of the equation, when the double side of the equation is affected, that the equation will change. So if you look at it, we have seen how this uh, agrees. Now, there is other elements like revenue or income and expenses. So revenue and expenses also affect the accounting equation. I'll just tell you how income is defined in the conceptual framework of financial reporting. Increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. Okay, so we have seen that we are talking about increase in assets and decrease in liability. Now, we said that this increase in asset and decrease in liability does not concern contributions from uh, holders of equity claims. So let's assume the company borrowed money is not seen as income because that borrowing is equity claims. Or they brought in money, the shareholders brought in money to the company. That is not an income. That one too is something that comes from the from equity claims. Long-term borrowing, sorry, this one's for long-term from borrowing from liability, this one's from equity claims. So all those ones are not income. But uh, any other one that brings about changes in equity and in assets is known as revenue or income. So all the money paid to us on the ordinary course of business is known as income. It excludes the money we sold from our assets. It excludes the money we got from a bank loan. It excludes the money we got from our ordinary shareholders where they paid money. So everything that is not part of our daily business activity is not our income. Even though we may sell an asset 100,000 naira, we must know that it's only when we sell it at a gain that we recognize the gain as income. That is not the normal, regular income. We might also make a loss from it and recognize it as a loss. So we're saying that when there is a change in revenue, it will affect the in income, it will affect the balance, the accounting equation. So in this case, let's look at, we made a sale of 500,000 naira, and then it cost us, total cost of this sale or cost of sale is 300,000 naira. So we have 200,000 naira as our income. So in this situation, what has happened? The asset of the business has increased. This 200,000 naira might be in cash or in receivables. The 200,000 naira might be in cash or in receivables. So what it means is that our total assets has increased by 200,000 naira. Now, the other leg of this will go to retained earnings, the profit for the year or whatever it is. So which means our equity will also increase by that amount of money. This is what uh, income does to our statement of our accounting equation. We have made an income of 200,000 naira, which will be added to this, because it's either going to be cash or it's going to be receivables. I've already explained about assets, the things that make up an asset. And then I'm now saying that this profit that we made will be what is called retained earnings, because we have made that profit, we did not distribute it, we did not pay it as dividend to shareholders. If we paid it out as dividend, all this amount we paid it out as dividend, then the statement of the accounting equation will remain the way it is. It will not change because we have paid all the money out. Now, let's also look at expenses. When we make an expense, so here we raised a cash of 200,000. I just want to continue to change the statement, the equation. Here is 350. Here is, no, here is nothing. Nothing. Here is 200. So we have 2,250,000 equal to 350,000 plus 1,900,000. So you see that it still agrees. It still agrees. The same thing goes to expenses. The expenses decrease in assets or increase in liabilities that result in decrease in equity, other than those relating to distributions to holders of equity claims. So when our assets decreases, we have made expense. And when our liabilities also increases, we have made expense. But however, we must not relate it to those ones that affects, those ones that come about as distribution to holders of equity claims. So let's look at things like payment of dividends. Payment of dividend. This is paid to holders of equity. So in that case, it cannot be said to be expense. It's paid to uh, holders of equity, the owners of the business. So we don't look at it as expense. That is why uh, we will not see it in the statement of profit or loss and other comprehensive income, but it will be in another statement, statement of changes in equity. That's where it will be payment of dividend. But however, if we pay something like rent, we pay something like rent, it means, let's assume in this place, in this liability now, we're owing rent of 100,000 and then we paid that rent. It's an expense. So what happens is that we're going to remove 100,000 here and then we'll remove 100,000 here. Here will remain the same. So in this case, we have 2,150 equal to 250 plus 1.9 million. So this is how expenses also affect the accounting equation. Yes, so we will also try to see how we can use this accounting equation. Why is it important? Of course, we can use accounting equation to determine uh, profits. Profits. So if our equity increases at the end of the period, we see that there is a profit that has been made. So when our beginning equation is 1 million equal to 300,000 plus 700,000. And the closing comes down to what we say I think this is what we had. Let me check. Yeah, that's it. So we have now seen that there is a difference between the equity. But however, we should take note that there were other transactions that were not income. So in this place now, we have our income, we have our equity, we have our liabilities that has changed to bring about this. So when we analyze this, we'll be able to know the income that was made in the year. We'll be able to know the additional, what's it called? Additional contribution from the equity holder. And when we analyze this, we are also going to see the difference in the, what brought about the difference in the equity. The same goes to asset. We use the accounting equation to see whether our account is balanced or whether it is not balanced. A situation where asset is no longer equal to liability and equity, it means that our accounting equation did not balance and we have done something wrong. We did not do the correct debit and credit. So we can test our debit and credit using the accounting equation. That's why when we prepare statement of profit or loss, we need to prepare statement of financial position. If the statement of financial position balances, then we are sure that we did the right debits and credit. If there are no errors, because there are some errors that will not affect this, it will just replace itself and you think that there was no error. But however, it's a very good way of determining whether there is an error in the account or whether there is no error in the account. At least you should know that the debit and credit, barring compensation and all the rest, or error of original entry, as the case may be, that the statement of financial position is correct. That will also tell you that the statement of profit or loss that you prepared before, that one is also correct. So we use it, and we use it for other things. I would say go ahead and find out the other uses of the accounting equation. Let me give this and see how you can handle it. Let's assume we have assets is equal to liability plus equity. And then we have 1 million 300,000. Okay, let me change it to 400,000. And then plus 600,000. 1 million equal to 400,000 plus 600,000. So let me give you this scenario one. Issued share of 700,000. Two, borrowed money from bank, 300,000. Three, purchase goods of 2 million, paid cash of 1,500,000, while the rest are on credit. 4, bought furniture and fitting. 200,000 naira cash. Okay, so I have these 4 transactions. I want you to follow what I have done and let's see how it will affect this equation that is on the board. Let's look at, if you do this one, you add it up, you do this one, add it up, you do this one until the final one. Let's see what the last equation will be. It's moving from 1 million equal to 400,000 plus 600,000. We want to see what the final equation will be. So far so good. Like I told you, I was taking unawares, but I believe that I have tried my best to do justice to the topic. We are trying to edit a video that we're going to upload within this week. It's about business combination. I've been teaching concepts in business combination. Now I have taught the full business combination. So don't miss it. Go there and watch it in my playlist when it comes out in the YouTube. And then also do well to watch the other ones in order to understand it fully. Thank you very much. I think this is where we'll end the live stream.